The biggest risk to the United States economy was never the AI bubble. It was never China, and it was never the orange man in the Oval Office. It is something much more boring, and it is something you have likely never heard about unless you have gone deep down the finance rabbit hole. And that is exactly why nobody is paying attention to it. If you have been wondering why mortgage rates refuse to fall, why stocks randomly freak out every few months, and why the Federal Reserve can talk about cutting rates, but the economy still feels completely suffocated, the answer doesn't start in Washington. It starts in Tokyo. More specifically, in the most boring asset on Earth, Japanese government bonds. Because the country best known for anime and Nintendo has also been the duct tape quietly holding the global financial system together for the past 30 years. And today, in 2026, that duct tape is starting to peel off. To understand why Japan is so important, you have to rewind to 1992. Japan's massive asset bubble burst. Real estate collapsed, equities collapsed, and Japan entered what became known as the lost decades. There was no real economic growth, no inflation, and no wage expansion. It was like the economy hit pause and nobody could find the remote. So, the Bank of Japan did what central banks do when they are out of options. They cut interest rates to zero. Then, they cut them below zero. And when that wasn't enough, they introduced something called, quote, 1. It sounds like a Marvel villain, but it actually just means, quote, 2. Basically, the Japanese government superglued interest rates to the floor. For decades, Japanese bonds yielded pretty much nothing. This created a massive problem for Japanese investors. Imagine you are a Japanese pension fund. You have $1 billion, but your domestic bonds pay you 0%. You have two choices: accept zero return or go shopping overseas. They chose option 2. Japan entered a multi-decade global shopping spree. They became the largest foreign holder of U.S. treasuries, massive buyers of U.S. mortgage-backed securities, and the world's absolute largest creditor nation. Japan became the world's ATM, and here is how the math worked. Meet Chad. Chad is a hedge fund manager who thinks he is a financial genius. Chad goes to the Japanese markets and borrows money in yen at near zero interest rates. He converts that yen into US dollars and buys US treasuries that yield 4 or 5%. After paying some tiny hedging fees, Chad pockets the difference. He is literally making free money. This became known as the yen carry trade. But when borrowing costs are zero, Wall Street doesn't just buy safe treasuries. They buy tech stocks, they buy real estate, they buy risky emerging markets. If it had a pulse and yielded more than 0%, they bought it with borrowed Japanese money. At its peak, this trade was estimated to be worth trillions. The entire global market was essentially running on Japanese Wi-Fi. But the entire system relied on one single assumption: that Japanese yields would stay near zero forever. In 2024, that assumption broke. The Bank of Japan ended its yield curve control and raised interest rates for the first time in 17 years. And then they did it again. The reaction was violent. In a single day, the Japanese stock market plummeted over 12%, its worst drop since Black Monday in 1987. The S&P 500 nosedived. It was a clear signal that markets were officially terrified. Because when Japanese yields rise, two things happen. 1. Borrowing in yen becomes expensive. And 2. Hedging your currency risk becomes expensive. Suddenly, Chad's quote 3 trade isn't free anymore. The math flips. And when the math flips, the capital flows flip. The trillions of dollars that flowed out of Japan for decades started returning home. This is called repatriation, and it is the biggest hidden threat in global markets today. The cheapest source of global liquidity for the past 30 years is officially closed. And this is where it hits the American middle class. For decades, Japan wasn't just some random buyer of US debt. They were price-insensitive buyers. They bought our debt no matter what. Legendary billionaire investor Ray Dalio put it perfectly. He said the bond market is the backbone of all markets. It determines what all other asset returns are going to be. When the supply and demand for bonds breaks down, long-term rates rise, currencies swing violently, and central banks are put in a bind. Right now, everyone is hyper-analyzing Jerome Powell's press conferences like it's a new GTA 6 trailer. But they are looking at the wrong thing. The Fed only controls short-term rates. The long-term rates, like the 10-year and 30-year yields, are determined by supply and demand. The United States is currently running trillion-dollar deficits. The Treasury has to issue massive amounts of new debt every single year just to keep the lights on. Someone has to absorb that debt. For 30 years, Japan was our best customer. If Japan steps back, yields must rise to attract new buyers. This is why the Fed can cut rates, but your life doesn't get any cheaper. Because if long-term Treasury yields stay high, mortgage rates stay high, the housing market stays frozen. It affects stocks too. Analysts value companies based on long-term yields. If yields stay high, stock valuations compress. Companies can't borrow cheap money for stock buybacks anymore. Growth slows. The oxygen leaves the room. There is a reason why traditional financial media is ignoring this. It is because it's not clickable. Nobody on TikTok wants to hear about the cross-currency carry trade. They want to hear about AI and whatever Nvidia did last Tuesday. They want you to believe a simple lie, that one Fed rate cut fixes everything. But liquidity isn't automatic, and someone won't always show up to buy our debt. The real threats in the market aren't the loud ones. The real threats are the ones hiding in plain sight. If you want to understand the forces actually moving your money, hit subscribe. I read the boring charts, so you don't have to. See you in the next one.